Welcome to Asking for a Trend. Breaking news. Apple earnings just now hitting the tape. And Yahoo Finance's Dan Howley is here with the numbers. Dan.
Yeah, Josh, big beat for Apple here on the top and bottom line. They said they recorded all-time record revenue for the iPhone, $85.3 billion. That's well ahead of the $78.3 billion that analysts were anticipating. The company saw $69.1 billion in the prior quarter. EPS came in at $2.84 on revenue of $143.8 billion. Analysts were anticipating $2.68 on $138.4 billion. So again, a big beat there. Services revenue was in line with expectations. And then we had Mac, iPad revenue at $8.4 billion and $8.6 billion respectively. Wearables came in at $11.4 billion. But one important aspect of this is greater China sales. Over the last 3 of 4 quarters, they had seen declines in that region. But now in this quarter, they had $25.5 billion in revenue. That's up nearly 38% year over year. So a big return to growth there out of China. This was something that Tim Cook had kind of telegraphed in the prior quarter earnings call, saying that they were expecting huge iPhone sales. Part of this has to do with kind of the lapping of people going out and purchasing tons of new smartphones during the COVID era. It's been 6 years now. People upgrade around that kind of time. The new iPhones, the 17, 17 Pro, they're interesting. They have slightly tweaked designs. I think it'll be interesting if we get any kind of color as to where the iPhone Air was in terms of sales. We have been hearing different inklings that perhaps sales volume of that particular model have been a little disappointing, and that a lot of people are flocking to the Pros and the standard iPhone 17. They don't really break those numbers down anymore, so we'll just have to wait and see. It also will be interesting to see what Tim Cook has to say about the recent tie-up with Google, where Apple and Google are going to be kind of combining with AI and having Google's Gemini power Apple's next-gen Siri.
Dan, let's just talk about this iPhone revenue number for a second, because this is still Apple's bread and butter, of course. This is blows past what the street was looking for. I mean, it clocks in around 85 billion. Analysts had penciled in closer to 78 billion. We knew going in here, Dan, that analysts had modeled that, listen, this iPhone 17 cycle has been strong. It's been solid. Why has it been solid, Dan? What's been driving that?
Yeah, I think it's that COVID kind of, timing, right? I mean, we'll probably see that throughout the next year, maybe 2, just because it's one of those things where people go out and buy. You don't buy a phone every 2 years now, right? You're not on a plan that lets you do that. So, you pay it off slowly over time, and then, maybe you just held on to it because you're like, well, I just paid off that part of the bill. Why do I want to tack something else on? And now you're probably thinking, all right, well, it's due. I'm several generations behind. I want to get the new hotness. I don't think anyone's going out to buy this because of Apple Intelligence. I don't think anyone's going to do that at any point unless this thing can, I could say, hey, Siri, get me tacos right now, and it personally delivers the tacos to my door. That's not happening. I think a lot of this has to do with the improved cameras, the improved screens. The battery life is a lot better. The slightly changed design, I think, piqued people's interest. If you look, you'll see a lot of people who have the new phones in that burnt orange color for the Pros. I think that got people pretty excited. And so that's where I think a lot of this came from, not necessarily, the fact that people are interested in iPhones again. It's just, I think that timing lines up. And, we saw that kind of with PCs this year, where PC sales in general were up 9% for 2025. It's that kind of lapping of the time frame where people go out and they say, okay, 5, 6, 7 years, that's where I need to go out and get a new device. TV sales might start to pick up soon too, because that's, another kind of device, but that's for another day.
Does it tell you anything too, Dan, just about how much time we spend talking about AI and consumer AI? But is this a window into how much does it really matter to a lot of consumers, whether it is a must-have feature or no? Right now, what consumers are focused on is listen, what they've always been focused on with iPhone at least, which is it's the processor, it's the battery, it's the camera.
Yeah, I've probably said this enough to be annoying, but I don't think that people are going out right now and saying, boy, I really need to buy a new iPhone for that Apple Intelligence. And I don't think people are going out and saying that with their Google phones or their Samsung phones. A lot of people still use ChatGPT, obviously. You can use that through the app. If you have a Samsung or Android phone, you can access Google's Gemini through their own individual app there. For Google's Pixel phones, it's built right in, right? So I don't think people are necessarily going out and saying, I need to buy a new phone because of AI. They're going out and saying, I need a new phone because my battery sucks. They're going out and saying, I need a new phone because I want a better camera or the screen looks better. That's how people buy these devices. The software is the software. No one, when Siri came out, no one said, guys, let's talk to our phones like bozos, in public for no reason and ask it to play a song and then have it fail 8 times. They said, no, let's go get a new phone because the camera's good, the battery's good. And that's exactly what I think happened here. It's a great device. They updated the software with the liquid glass display. Whether or not people like that or not, that's up to them. But I think it's just a matter of the hardware being new and interesting again for the moment. Next year, we could have a foldable phone. That could even spark greater sales, although I'm kind of worried about the price tag on that.
Dan, as always, appreciate that instant analysis, buddy. Thank you. Well, here with more on Apple's latest quarter results, we got Seaport Research Partners senior analyst, that would be Jay Goldberg. Jay, it is good to see you. So, listen, we have Apple's results. We don't have the guidance yet, Jay. As always, we'd expect executives on the call to offer some more color and commentary about what they see ahead. But give me your take on the quarter, Jay, and especially what you make of this iPhone revenue number, which easily beats the street. I mean, it came in, Jay, around 85 billion. The street was closer to around 78.
Yeah, so far so good. I mean, my basic thesis on Apple right now is very, very tactical in that the current cycle of phones, the current cycle of products looks really strong. People are buying those phones. Your previous guest was saying the same thing. People like the new phones, and sometimes it's as simple as that, right? I think the numbers look good, both in terms of top line for revenue, for iPhones, for China. China looked better than expected. And most importantly, for gross margins. The gross margins look really good this quarter, way above where I was expecting them.
I do want to talk about AI for a second here, though, Jay, because we know, listen, we heard Apple's going to use Google's Gemini models to power its AI efforts. That's going to include a more personalized Siri. I'm just curious what you make of that, Jay. What kind of impact you think that could have on the next iPhone upgrade cycle, in your opinion?
So I think ultimately AI is an existential threat for Apple. They need to get it right. But the good news is that they have time to do that. They don't need their own model today. They are in a good place working with Google, working with some of the other companies to sort of exist on the platform. Siri just isn't all that, right? It's not that exciting. It doesn't do that much, and it could use for people want better experience now. Though they're used to what ChatGPT or Claude has to offer. And having Google behind them should get Siri to someplace that's at least functional and useful, and give Apple time to sort out its own house and get its own AI team to where it needs to be.
Jay, you mentioned margins. Let's stay on that for a second, because that was a big topic of debate heading into this print. A lot of your colleagues on the street were writing about this, and specifically the rising memory cost, Jay, and they're wondering, okay, they're trying to game out and model what could that mean actually for Apple's pricing and margins in the quarters ahead. How do you see it, Jay? What levers does Tim Cook have to pull on that?
So it's a big question. That's why I'm really waiting to hear what they have for the guide. That's going to be critical. They did get asked about memory prices on their last earnings call a quarter ago, and they said that they had put in place long-term agreements with the memory vendors that sort of lock up pricing for some long period of time. Since then, spot prices for memory have just kept going up and up and up. And eventually contract prices will converge with spot prices. And so that's a sort of ongoing risk this year, looking at where they're going to see, are they going to keep to that story that they have these long-term price agreements in place? It's really important for Apple, especially on the margin front. They make a lot of memory from memory, right? When you buy an iPhone, you pay an extra $100 to get another whatever amount of RAM or flash. That has a lot of margin baked into it. It doesn't cost them $100 to do that. And so what are they going to do sort of with those price increases? Are they going to make the consumer eat them? Are they going to, fit it into their own gross margins? We don't know. The guy's going to tell us a lot. And I think that plays out later in the year when we get what is probably going to be a folding phone. That's going to be pretty expensive. How much elasticity is there for demand? Are consumers going to pay big numbers for that? That may save them in the end.
What about Greater China, Jay? That's another important data point I just want to run by you. Q1 Greater China revenue, $25.5 billion. That was a beat. Your colleagues on the street, the estimate consensus, Jay, was more like 21.8. What do you make of that number? How do you see business for Apple in China kind of evolving from here?
I think Apple is in this weird place where it has to be walk this very fine line. Like they're very dependent on China, both the market and for their manufacturing base. They're probably too dependent for their own good. So they have to walk this fine line between, Tim Cook going to see the president every occasion and saying all the right things in China. So far, they've maintained that. I think the fact that they're doing well in China, as we see a lot of changes taking place in the Chinese smartphone market, prices are coming down for all their competitors there. Apple's doing really well. It's a good sign. Like consumers in China still like Apple. They still like the brand, and I think that will carry the weight for at least for the time being.
Jay, great to have you on the show today. Appreciate that analysis. Thank you.
Thank you.
Stick around. Much more Asking for a Trend still to come. ETF inflows already topping $100 billion within the first few weeks of 2026 after smashing records in 2025. But what does that mean for the price action? Yahoo Finance's Jared Blikre breaks it all down in this installment of Stocks in Translation.
Yes, money is pouring. Yes, money is pouring into ETFs in 2026, and the pace is already setting records in everything from stocks to gold and silver to new leverage bets on your favorite tech stocks. But here's the head scratcher. If ETF flows are strong, how come sometimes they trend down? And flip that over. If prices are ripping, why do flows sometimes flatline or even trend down? On today's Stocks in Translation, we're going to answer those very questions. And first, let's start with some basics. An ETF is a bundle of stocks or other assets like bonds or commodities that trades like a stock. ETFs have two numbers that people might confuse: price, what investors are paying right now, and flows, what the ETF or whether the ETF is adding shares or shrinking. Price follows the value of everything it holds all day long, at least in theory. For flows, most of the time, ETFs trade like a stock. Investors are just swapping ETF shares with each other. So there can be huge volume with no new shares created at all. Flows change only when the share count changes, which is tallied at the end of each day. Shares can increase or decrease when big trading firms, market makers, and broker-dealers swap stocks or cash for ETF shares, or do it in reverse. That's a process called creation and redemption. And the dollar value of flows are how much the shares have changed over time and what's inside per share. But you don't need to focus on the math. It's just to help explain why flows and price do not move in lockstep always. Flows tell you that the number of shares of the ETF have changed, not that every stock got a fresh bid. Now here's the head scratcher. Even if flows are positive, price can still fall. Flows are support, not a guarantee. If there's more selling in the underlying market than buying, prices can trend down, even while ETF shares are being created. And the reverse is true too. Prices can rip on a small group of aggressive buyers, even if the flows look quiet. Now let's put that on the cleanest current real-world example, small caps. And we've got a chart here from Todd Sohn at Strategas ETF Research, which shows a one-year change in small cap ETF flows in billions of dollars in white. And the green line is a one-year % price change. You can see that after the initial pandemic sell-off in 2020, both flows and price got a huge jump, and I'm circling that right here. And flows stayed pretty high even as price growth fell, and eventually turned negative in the 2022 bear market. In fact, flows stayed positive that entire time and throughout the first 2 years of the bull market in 23 and 24. That's this white line right here, and it turned up. But after price failed to take out the highs in late 2024, investors saw a double top and flows collapsed. You can see that white line eventually fell into negative territory where it still is right now. And that's despite the Russell 2000 trouncing the NASDAQ and the S&P 500 this year in performance. So don't read flows like a crystal ball. Read them like crowd behavior. Are investors showing up consistently, or are they backing away? Right now, flows are showing that the crowd is getting a little bit more interested in small caps. Now let's zoom into some sector flows. And here we have cumulative flows since the release of ChatGPT in November of 22, which is also when this latest bull market began. And this is from Todd Sohn as well. Tech has been the main magnet, and that's the white line that's been trending up. No surprise right there, and I'm tracing this out in red. But look at healthcare versus energy, both still in negative territory at the bottom. But they are inflecting up a little. Healthcare in green has been coming back to life. Price turned up in the middle of 2025, and flows have been improving, although it's a little hard to see here. That's what it looks like when a trend starts to get sponsored by real money. Now, energy in blue is the other version. Prices started to perk up this year, but flows are just barely turning up yet. So it's still an unloved move. And if flows start kicking in, that could add fuel. And if they don't, energy can stay a grind. So here's what to watch next. For small caps, do flows keep turning up and show year-over-year growth, even if price doesn't hit new highs every day? That would be strength. For healthcare, do flows keep improving after last year's upturn? And in energy, do flows finally grow as price rallies? If not, we might see more choppiness in price. And finally, silver. Do flows hold up after a price drop? We've seen gangbuster excitement in numbers, but in a highly speculative asset, that can turn on a dime. So tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Back to you, Josh.
All right, Jared, thank you. Stick around, much more As for a Trend still to come. Shares of Southwest Airlines surging after forecasting strong 2026 profit, following new bag fees and seating policy changes. Southwest CFO Tom Doxey joined Julie Hyman on Morning Brief to discuss the latest results.
Well, we've simplified things, I think, for the investor community, where we've gone with a simple earnings per share metric. We've done that for the quarter, and we've done that for the year. 2025 was really a foundational year for us. We put so many things into place, things like bag fees, changes to our loyalty program, all the preparations that we needed for extra legroom seating and assigned seating, which it was executed really well by our teams earlier this week. All of that laid a great foundation for us now as we move into 2026. What we're guiding is earnings that are 300% greater than what we had in 2025. And so it's really now the financial impact of all of those things that we put into place that are now resulting in this really strong guide for us for 2026.
So, Tom, this is you guys pulling on all of those levers. I am curious about underlying demand. It sounds like you're counting on making more per passenger, but what do you expect traffic to be like for the balance of the year?
Demand's been strong for us so far this year. I think there's a lot of demand for our product. When you look at the things that we've done, every single day we have more and more of our aircraft that have our brand new interiors, things like the new lighting, in-seat power. Of course, we announced free Wi-Fi for all of our Rapid Rewards members just a couple of months ago, and that's in place now. So all of these things, all of these product elements that we've rolled out really have helped to have really strong demand for us as we've started the year.
And Tom, there have been some questions about sort of overall consumer spending, consumer confidence, how that's affecting how much people are flying and which airlines they're flying for that matter. Any color you can give us on that and what you're seeing?
The consumer's been strong for us as we've started the year. We at the end of last year, so we had a guide that we had put out for a full year EBIT of $500 million. And we saw a lot of strength as we were ending the year on the revenue side. We finished well on the cost side, too, continue to spend smartly as a company. We ended up with $574 million in EBIT for the year. And so, as we approached the end of the year, we really saw a lot of strength. And that's continued as we've come into this year.
Tom, among the big changes you guys have made to Southwest, you rolled out the starting to charge for baggage late last year, but this is the very first week, as you and I speak, that you guys have transitioned from open seating to assigned seats. And this is a big cultural change for Southwest. Have you been in any airports? Have you seen how it's going? What are you hearing?
It's going really well so far. Our teams are just incredible. One of the things I love about Southwest is our culture and our teams in all of the different airports. We have an internal Facebook site. We're all making different videos. Everything from bye with passengers in the background waving. As our folks were dancing in the front. Everything from that to just really funny little sketches that people did. We were ready for it. We had all of the technology in place. We had all of the training in place. I did a post earlier in the week where I was highlighting part of my team which was our facilities team, which changed out over 700 gates in one night. So we were ready for it. It rolled out really, really well. And this is something that's resonating with our passengers. So for those that were choosing not to fly Southwest, 80% of them gave as the primary reason the lack of assigned seating in the boarding process. So that's something that we're changing, and it has resonated really, really well for us.
And speaking of which, Tom, another feather in your cap is that the Wall Street Journal awarded you guys Best Airline for 2025. And one of the things I have to admit that surprised me, I mean, they ranked a bunch of things, delays, cancellations, et cetera, but they also look at consumer complaints. And you guys did not have a high complaint rate, even as you were making some of these changes last year that we're talking about. You would think people, especially longtime Southwest customers, would have been troubled by those changes. Why do you think they weren't?
It was a huge deal for us. We were number 2 last year, just barely number 2. And this year, for 2025, by a wide margin, we were number 1 in the Wall Street Journal rankings. And as you said, think of it like a portfolio of operational metrics. So where anybody can point at one and sort of craft a story around one particular metric, maybe create a metric of their own. This is broad-based, saying that we were the number 1 carrier in the U.S. for all of those operational metrics. And you're right, we were number 1 for the least amount of customer complaints. Our people are incredible. Our policies are customer friendly, and we've made so many investments in the product and what we're doing. Again, these new interiors with new lighting and big overhead bins, the in-seat power, free Wi-Fi. So we've invested so much, and there's more to come. We're not done yet. We've done so much to lean into the customer. We're not done.
Lastly, Tom, I got to ask you about this winter storm here. I know Dallas was certainly affected by ice and snow. We got walloped here in the Northeast. What can you tell us about the effect that had on operations?
Well, again, our people are just incredible. And of the larger carriers, we had the lowest number of cancellations during that period. It just speaks to the investments that we've made in the operation and our people and the technology that we have. That was likely about a $30 to $40 million impact to us. And as we said in our materials that we released, that is included in all of the guidance that we've given. Storms happen. That's part of being an airline, is being able to operate well during those storms. And I couldn't be prouder of our people for the way that they executed.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.